Okay, welcome everybody. I'll do a bit of looking because I'm the video there, but then we'll go up to the screen and start talking in a moment. So for those that that don't know me or haven't been to one of my presentations here before, and it's been over 12 months, I think I was here February last year, and then last face-to-face presentation that I did, I think. So it's good to be back presenting, but my name's Tim Miller. I've been presenting for ASF and working with ASF for too many years to mention. So I have a nice solid relationship with the group here. Today's presentation is going to be on related party investments. We've got our interstate attendees as well, and those that are sitting at the desks attending. So I will look down at the screen occasionally if I've got any questions so that we can sort of relay the questions that are coming in externally as well. But the way that that I like to run these things is to make sure that we have questions and we ask them as we go along. So please, if you've got anything that you want to ask, don't be afraid to call it out. If I can get perhaps someone from anywhere else to Shelley, yeah, is it possible to have the laptop put in front of me? It's a little bit difficult to do that. So I'm actually going to switch to the screen so you won't need to see me from a video point of view anyhow. So I will keep it on the side, unfortunately, there, Shelley. So what I'm going to talk to you about today is related party investments and investments in private companies and the like from a self-managed super fund point of view. So I was discussing this matter with Shelley with reference to a number of the questions that you had about certain specific issues with self-managed super funds, and this whole in-house asset, private companies, private trusts is a common theme that creates issues for self-managed superannuation funds. So I've taken a presentation that I've actually delivered here probably about 3 years ago, and I've updated it with reference to some key issues which have primarily been taken on board as a result of COVID-19. So what I'm trying to do is, now that you're in and well and truly in the thick of auditing 19-20 financial year, that's obviously our first COVID impact year with regards to these sorts of investments. So it's pretty important to understand some of the key issues associated with these types of investments, because they're actually going to have long-lasting impact from an SMSF point of view, and they're going to impact your audit this year, they're going to impact your audits next year, and subject to how long it takes trustees fixing a lot of these issues, it's going to potentially impact audit for many years to come. So it's important to understand the issues associated with them. What I actually want to try and address is some of the definition issues and to be mindful of what there are associated with in-house assets versus other styles of investments. And then I'll also touch on a little bit about valuation stuff, because valuation is clearly a critical part of the audit process. So trying to get a bit of an understanding for that as well. So what we'll talk about is the restrictions with regards to self-managed super funds and investing in private companies and trusts, and then the correlation between the in-house assets and the financial assistance rules. So with regards to the in-house asset rules, they are a very specific set of rules around certain types of investments, and then financial assistance is another very specific set of rules around almost exactly the same set of circumstances, but with one or two minor differences. But those differences are major when it comes to compliance. So when we're talking about an investment that is an in-house asset, we've got 5% of the fund assets that we can deal with. When we're talking about the provision of financial assistance, we've got 0 that we can work with. And so what we need to understand is really highlighting the difference between both of them, so that we can then work through, from an audit point of view, what's breach, what's not a breach, you know, what should we be communicating back to the SMSF trustees with regards to their compliance obligations. And then just some of the general other in-house asset rules I want to work through for the presentation. After the presentation, I'll send everybody through a copy of the note. So there's a lot more words up on the screens than I'll necessarily be talking through. I'll be talking more through the concepts. Then you've got the information to be able to back it up a little bit afterwards. So the key things that we need to understand with regards to these investments, it's very simple. I look at the in-house asset rules, and having dealt in self-managed super funds for as many years as I have, I sort of try to break it down into some really simple questions that we can ask ourselves, all right? And really simple questions that people like myself should be asking of the trustees before they entertain entering into a transaction. And often what happens is we get to audit and we're at the too late stage. All right, so we get to the stage where we're reviewing the fund and the transactions, and then people start asking these questions. We really need to educate them to start asking these questions up front. The first question is certainly, what is the investment? Right, now that seems like a bit of an odd question when we're dealing in this space, but that's going to help us identify, are we dealing in listed securities? Are we dealing with managed funds? Are we dealing with collectible and personal use assets? Because if we're doing that, that's a whole different presentation and a whole set of different rules. Right, so if we're knocking out listed securities, if we're knocking out managed funds, right, and the general simplicity that applies around those sorts of investments, then what are we actually dealing with? And if it's not a standard investment, right, then the next question is, who are the parties to the investments? Right, so the valuation for us is the last thing that we're really trying to address. And what we're trying to find out first is, what are we investing in? Is it standard or not? So is it just something that anybody with any sort of investment knowledge will be able to go and invest in, fixed interest or those things? If it's not that, then who are we investing in? And probably the most complex scenario that self-managed superannuation funds have to work out is whether or not the parties they're dealing with are related parties or not. So I'm going to work through that process or step through that with you. In most circumstances, for self-managed super fund, it's pretty simple to work out whether it's a related party or not, because most self-managed super funds, the members deal with themselves. Right? So determining whether or not you're related to yourself is generally a pretty simple question. Right? You don't have to dig too deep into the mindset to work out whether or not you are a related party. But once we start dealing in the concept of trusts and companies, then the rules get a little bit more, I guess, difficult to understand in certain circumstances. And so we do need to address certain areas. And so I'll touch on those sorts of areas. So who are the parties that we're dealing with? And if those parties are related, then is that investment subject to an exemption? Right, so once we get to related parties, again, it's still not yet about the valuation at this point in time. Once we understand that we're dealing with a related party, then we need to work out, is this investment, is it exempt from some of the restrictive investment rules? So business real property is one of those investments where we can invest in property where we're operating a business from. If we're leasing that property back to a related party, then it's entitled to all sorts of exemptions. We still have to be dealing on an arm's length basis and other things, but it's far more flexible than certain other investments. So is there an exemption in place? And we'll work through those exemptions. And then after that point in time, once we get to the point where there is no exemptions, then we're dealing in the valuation. That's when 5% becomes the most legitimate question. Right? So historically, we've always had this thing when people are dealing with related parties, the first thing we go to is what's the value of that asset versus the rest of the values of the fund. And if it's over 5%, a little bit of panic might set in from a trustee point of view. And if they go and address the other issues first about whether an exemption applies or not, then we can determine whether that 5% is going to be a bit of an issue. So that's the way I like to address these things. What's the investment? What are the parties, or who are the parties to the investment? Is there any exemption that applies to it? And then if there's no exemption, what is the valuation? And if you apply those sorts of, or that approach from an audit point of view, then it will certainly help direct you at least to the regulatory issues that you might be confronted with in dealing with self-managed superannuation funds. So once we get to that point of view, we need to understand, okay, well, they're the questions we want to ask, but how do we get to those questions? Sort of like what's the relevance of all those questions? And the relevance comes back to this issue of in-house assets, right? Investment in related parties for a superannuation fund. So an in-house asset is, for want of a better term, a loan to. I've kind of highlighted the key words on the presentation, a loan to or an investment in a related party. Right, so here's the first trigger that when we start to talk about financial assistance, we've already got a legislative anomaly. So we can lend money to a related party. Right? That is one provision that provides us an opportunity. We'll then talk about the exceptions and other prohibitions at the moment. So we can lend money to a related party. We can invest in a related party. So again, from an advice point of view, so pre-audit, right, when we're talking about things at the advice level, if I'm out there talking to advisors who are talking to trustees about investing in related companies, then what I'm going to be addressing with them is, do they want to lend money to that company or do they want to invest in that company? And when we start to address the in-house asset rules and the 5% limitation on in-house assets, well, there's a couple of things to be mindful of in this space. Is if you loan money to a party, then in theory, and hopefully in reality, the value of that loan decreases. Right? So over time, the value of that loan decreases. So as the fund assets increase and the loan value decreases, you're moving further away from 5%. Whereas if you invest in a company, so instead of lending money to a related company, you invest and buy shares in that company. Well, nobody buys shares in a company with the sole objective of those shares going down in value. Right? So the objective of investing in a company is to invest because the value is going to go up. From an in-house asset set of rules, that becomes problematic because if that investment goes greater than 5% of the total assets of the fund, then you've got a breach of the in-house asset rules and you'll have to act to fix that situation by ultimately selling down on those shares. So the definition provides for options, and those options are area from the advice piece point of view need to be dealt with the trustees. So a loan to or an investment in a related party, an investment in a related trust, and there's a differential between a related party and a related trust purely so we can identify the differences between companies and trusts from an investment point of view, or an asset of the fund which is subject to a lease or a lease arrangement to a related party. What's a lease arrangement? It's just a lease that's not written. So lease arrangements really were far more prevalent in the SMSF environment, I guess many, many years ago, where a lot of SMSF trustees used to have artwork, right? And you would ask them where that artwork was, and often they would be a little bit coy about telling you where that artwork was, which was generally a good sign that it was on the wall in the house, right? And they were gaining some form of benefit from it, right? And that benefit is they got to observe it and look at it every day. Well, under the superannuation rules, they're not allowed to do that. So what they would have in that situation is no formal arrangement would be in place. Like generally, if mum and dad have got a piece of art, they haven't got a legal document that says that they're renting that art from the self-managed superannuation fund and all the parties have signed off to it. However, if they did that, and when they used to do that, we considered them to have a lease arrangement in place, and we did require them to pay to display that art. Now, thankfully, that law has changed, and you're not allowed to display art in your personal residence. Right? You also ultimately cannot display it in your place of business either, under the collectible and personal use asset rules. So, the number of funds that invest in that sort of investment have changed and dropped dramatically over the last probably 10 years as such. So that's our definition of an in-house asset. So what's important for us is really identifying some of these key terms, what it means, how it links into some of the other provisions, and where it takes us through this post-COVID or continuing COVID, but post-investment exemptions that were given because of or as a result of COVID. So a key to it all, probably the biggest definition out of that whole in-house asset definition is the definition of related party. And in very simple terms, a related party includes all the other members and trustees of the fund, or Part 8 associate of the fund. And I'm going to touch on this concept of Part 8 because that's a legislative reference. We also have this definition of standard employer sponsor. That's not really relevant to self-managed superannuation funds, okay? Because standard employer sponsors are employers who have an agreement between the employer and the trustee of the fund. That's not what self-managers. Self-managers is an arrangement between the trustees and the members. And then if a member gives their employer authority to contribute to the self-managed super fund, it's a different approach. So really what we're looking at is fund members and their trustees are Part 8 associates, and an associate, the member under Part 8 of the legislation. But we need to know what and who these parties are in the SMSF space to kind of start the conversation or identify from a conversation piece who is a related party from an investment point of view. As I said, the simple option or the simple piece in all of this is the fund members. All right, so once somebody has joined a fund, they're a related party of the fund. Now, historically, we've seen all sorts of different sort of nuances of self-managed superannuation funds. You see the typical style fund, and that still makes up the majority of self-managed super funds. The other one that was relatively relevant, particularly in the early days of self-managed super funds, was business associates. So you might have had directors of a company, small business, set up a self-managed superannuation fund together. In the sense of related parties, that is problematic because if these two directors, if these two parties are not related by family or marriage, then by joining the same self-managed super fund, they become related, and then all of their associated investments become related. Then it subsequently diminishes their investment pool opportunities with reference to trying to invest in bigger and grander plans. Now, to give a very brief example of that is a lot of these sort of business entities might hold a unit trust, and that unit trust that might then go out and invest in other styles of entities. Well, if they're all part of the self-managed super fund together, that unit trust is very restricted in what they can do. However, if they're not related, so if they're in separate superannuation funds and they invest in a unit trust and they invest 50% each, then that unit trust is unrestricted in what it can do. So you can operate a business, that trust can borrow money, all sorts of other things can occur in that arrangement. But by those two unrelated people joining the same fund, they really restrict what they can do from an investment point of view in their self-managed superannuation fund. So the membership area is certainly a key area with regards to who's a related party. We've then got our relatives, partnerships, partners in partnerships. So I'll go through who is a relative and who's not. It's obviously relatively common sense as to who your relatives are, but the list is fairly long with reference to who we're trying to track in this space. But if you invest in partnerships, right, partnerships generally from a tax point of view is going to be two individuals who share a common goal, split that income accordingly, and then that income is taxed in their individual hand rather than in the partnership hand. But if you're entering into a partnership, then any partners in that partnership become related parties. Now, one of the most common types of partnerships we would see in a self-managed super fund environment would be tenants in common operating or acquiring residential property. Once you enter into tenants in common, you're going to split your expenses and do all those sorts of things, but you have this common interest in that asset, and so therefore you are in effect a tax partnership, and that can become problematic from that investment and other investments in the fund. So partnerships, tax partnerships are very sort of complex in the related party transaction, because not only are the other partners in the partnership related to you, but their spouse and children are also related to you. Now, we're now starting to delve into the area of people you might not even know, right? So people that might not be in a close link with you as a member of a self-managed super fund, because you're in a partnership with one person, their family gets dragged into it, and all of a sudden it broadens the level of investments that are captured under these related party transactions. So again, we're looking at that across all membership of the funds and all trusteeship of the funds. And then the final point is entities that are controlled by this broader group. So if we put everybody together, right, in the presentation, and we add all of the members, all of their relatives, all of the partnerships, all the partners in the partnership, all the spouses and children of the partners in the partnership, then that forms what's called a group. Right? And if that group collectively control a company or control a trust, then that company and trust are also related entities. And it's that control of the trust and control of the company that probably leads most SMSF administrators and auditors and advisors and trustees into the depths of, is this transaction possible or not, and what are the ramifications of entering into certain transactions. So really for me, the key issue is this whole controlling companies and trusts when we're trying to identify what assets are problematic for self-managed superannuation funds. Because we can't invest necessarily in individuals so much. It's just what we're going to invest in the or through the entity of a company or trust that's going to create issues for us from an SMSF point of view. So as I said, the family, fairly significant list of people there. Without me getting too, I don't even know the word, is it genealogical? I don't know what the word is when you go through the family trees and all those sorts of things. You know, you've got your stock standards, your grandparents, your parents, your siblings, and then you've got your lineal descendants, uncles, aunts, nieces, nephews, adopted children. All right, so all of these things are relevant with regards to the definition of relatives to related parties. It has other consequences for issues associated with estate planning and that as well, and dependency. And it differs to the definition of who is a relative for the purposes of self-managed super fund establishment and whether somebody is an employer or an employee. But in this sense, it is one of those areas that it's quite broad, and can be quite problematic because it also incorporates spouses. There are two parties, and I think we've got a question, so I'm going to jump to the question in a moment. There are two parties that are not included in this related party definition, and that's the former spouse and cousins. Now, why not cousins is a question I've been asked a lot for many years. I kind of always make up an answer ultimately, because to go into the hearts and minds of politicians back in 1988 or 1998 or whatever it was is too hard to do. It's one of those areas to say, right, well, cousins are excluded from this list, so let's just all accept that. Many of us wouldn't even know some of our cousins because they're so deep and far away with regards to relationships, but they're off the list. Right? Former spouses is an interesting one, because what this alludes to is that you can invest in your former spouse. Whether that is a smart idea or not is certainly a different issue. But in theory, you could invest in the former spouse. However, the one question I've had raised to me previously is, can my self-managed superannuation fund buy a residential property and lease it to my former spouse? Now, the short answer, without thinking about anything else, is maybe. Right? But the longer answer is, will your children, if you have any, ever stay in that house? Because then ultimately there's an indirect benefit to a related party. And I know some auditors, and I know that they would start to ask those specific questions. So we need to certainly be mindful of that. Let's just see what this question is here. Can I expand on the definition of partnership? Many of the team get the aspect of the definition who it involves incorrect. Okay, so that question about partnerships is really, and again, an extension of all of this area. It is quite broad. So there is a tax definition of partnership, and it is that joint income area. But I actually also think that you can extend beyond that into such areas. And it's an area that I will touch on a little bit more in our next presentation around property as well. But when you start to talk about joint ventures, right? So when you start to talk about joint ventures and self-managed super funds, that's all the rage at the moment. People saying we're going to enter into a joint venture to do a property development for our self-managed super fund. No, they're not. Right? Most people that say they're doing that, what they're entering into is a partnership. All right, two different parties coming together, sharing a common goal, and that common goal is to develop property or whatever. But they're bringing different elements to that relationship. But then it's an investment by which they're going to receive some form of gain or reward from it. Where partnership can get tricky in the sense of self-managed super fund is with law firms and audit firms and accounting firms. When you talk about the partners of the business, they are not a partnership in this true sense of the tax definition of partnership. That is more effectively, and I don't know the legal terminology associated with it, but that is more the term that has been given to that sort of business arrangement, which is not too dissimilar to directorship and other things. But partnership is effectively two unrelated parties coming together to share a common goal in some interest in creating tax returns and other things, versus say a business structure where you're otherwise looking somewhat like a director or a company. Are there any other sort of questions in relation to that area? No, good. That's about my limited knowledge on partnerships. No, look, it's one of those areas that, as I said, you really do need to address who the parties to the relationship are. And if they're lodging a partnership tax return, because partnerships are required to lodge tax returns, then generally you've got an issue. Joint ventures will often end up being incorporated entities, and then you're actually not entering into an investment in that partnership. You're actually investing in the joint entity company or the joint venture company. So that's where things start to get fairly complex and problematic with regards to these sorts of funds. So sufficient influence and majority voting interest. So the issue or the question that I wanted to raise from that previous slide with my controlled element down the bottom is that there is a definition of what it is to control it. And so I highlighted that we have the group, right? And the group is the collective of all those people working together. Well, then what happens is if that group, right, is effectively controlling the company or trust, then it's a related company or trust. So what I tend to do in this situation is I tend to always turn around and read this definition out, because it's one of those kind of very wordy, very difficult to grasp the concept of definitions. And it also very rarely applies in the true sense of SMSF investments. But if we look at the definition of sufficient influence, because the second part of it's pretty simple, majority voting interest is pretty simple. But sufficient influence, if the company or a majority of its directors. So we're talking about a company here. Here we're sitting around with the directors of the company. And what we want to know is if they're accustomed or under an obligation. And then of course they have to put in words like whether formal or informal. Now, if we've got the directors of the company and they are on a regular occurrence taking on board the actions or acting in accordance with the wishes of the group, then we influence that company, right? And so in effect, what they're saying is if you have less than 50%, because majority voting is greater than 50%, if you have less than 50% of the voting interest, do you wield enough power that the board of directors will act in accordance with your wishes, whether it's a formally written agreement or whether it's informal and they're just accustomed to necessarily doing that. Now, in most SMSF company investments, it's relatively straightforward when you identify it that it's a related company, right? In most instances, because you've got the shareholding, because often there's only one or two shareholders, right? So you'll be able to tell straight away. If you've got these 50-50 companies, then this sufficient influence bit becomes relatively significant, right? So if you've got a 50-50, then sufficient influence becomes significant, because if you've got 50%, but you wield all the power and the board acts given that you're one of the board members, if you act in accordance with those wishes, then you have sufficient influence. If you've got less than 50% and you throw out all your wishes and you say, this is what I'd like to do, and the board say, we'll take that on notice, but they don't necessarily act in accordance with that, then you don't influence that company. Now, from an audit point of view and an administrative point of view, we're dealing a little bit in hearsay, right? We're dealing a little bit in your word versus their word. So ultimately what we look for in this area is a declaration of influence. So whether or not you yield that influence. Now, the thing is, most people don't want this. Right? Most people don't want influence, because if you influence a company, then it's a related company. If it's a related company, then you're restricted to being able to invest only 5% of the fund's assets in it. So sufficient influence is not something we actually want to achieve, but we still have to ask the question with regards to what it actually means in the SMSF space. And so it's one of those areas that we need to certainly be mindful of with regards to how the fund operates. Majority voting interest, really simple. Have you got more than, has a group got more than 50%? If you've got more than 50%, you control the company. If you've got exactly 50%, then have you got sufficient influence? The 50-50 has always been an interesting conversation between fund administrators, fund auditors, SMSF trustees, because you might not be able to influence somebody positively, but you can influence them negatively if you hold 50%. So you can stop certain transactions from occurring. Ultimately, what you find is most self-managed super funds that engage in these 50-50 style investments, they're doing it a certain way to ensure that they're not related parties, but generally they're in a relationship where both parties are equally influential and neither one has any greater influence than the other. But there's a lot of questions that we have to ask in this space, and creates a lot of problems from an SMSF trustee point of view. Related trust, again, it's trust that we control, right? And we control it either by having more than 50% of the capital or income, sufficient influence, like with the company, or the ability of the group has the ability to remove and appoint the trustees. When you're setting up these related trusts, so a unit trust that is going to invest in a superannuation fund, one of the key issues is who is the appointer? What are the rules around the appointments of trustees? So we want to see the trust deed of these unit trusts where the self-managed super fund is one of a number of investors. But a deed I saw not all that long ago, a unit trust deed, and we had a self-managed super fund and they invested $5,000 in some trust. Right? Yet they were getting $80,000 worth of income out of that trust. I thought that seems like a fairly decent investment. Might need to get some of that one myself. But so why we got this fixed entitlement to 5,000 units at $5,000, so $1 a unit, but we're getting these huge distributions. So we asked a question, you know, is a fixed entitlement? They said, yep, we're only entitled to, we've got a fixed entitlement, we've got 5,000 units in the trust, right? But then you dig deeper into the unit trust and there was then discretion as to how the income was allocated from that trust. So it was a hybrid trust between being a fixed trust and a discretionary trust. Now that's just one example of where trusts can go wrong in the SMSF space, but another one is in the appointment and removal rules around the trusteeship. So I think one of the key documents we should be requesting when we've got investments in private unit trusts is a copy of the deed, so we can get clarity as to what sort of investment it is and whether or not the SMSF does control the trust. Generally, where you get problems with this is when you ask a question, can we get a copy of the deed? They say, well, no, we're not willing to provide that, or we are unable to provide it. That's generally a good enough red flag to suggest that there's some issues with that deed that suggests that there's something that's not quite right about the transaction. Because if there's nothing to hide, then it's going to be pretty simple to address these particular issues. They've got a so another question there from Shelley. I should have spoken to Shelley before and given her a question limit beforehand, before the presentation. But no, they're good questions, and so it certainly addresses some of these issues. And again, the sufficient influence, getting examples of that sufficient influence in the majority voting interest. So again, what I would be asking for is a declaration to that effect. So you could ask for a statutory declaration. Ideally, if you could get something from somebody else within the company, right? So if you get something else from the directors to say that these parties do not have that influence over us. Obviously, clearly the shareholding registry is beneficial, because then you can see whether we've got the majority shareholding interest or not. But all of these sorts of things lend themselves up to that capacity for us to determine whether or not sufficient influence is applicable. And clearly, if we can get it from a third party, it's even better. But there's always problems, I understand, from an SMSF point of view, in getting third-party valuations, in getting third-party declarations when you're dealing with related parties and related trusts. So really it's about asking the question, but also about asking the administrator to ask questions. And when I talk about valuations in a moment, what I'm going to touch on there is the ability to for us to or what we provide to our clients in that regard. So this one here just summarises that point that we made before about directors. So if the directors are not related, so if they're not relatives, including spouse of each other, then they're not related parties to each other. If they are not partners in a partnership, right, then they're not related. Another good example of the partnership to me, and I talked about, I guess, the concept of the tenants in common. So in a tenants in common, you know, if there's a shared bank account that they might have together, the income comes into there, then that would clearly identify that there was a potential partnership in place. The other one that I like to use as an example, and this is far more common than we probably think, but how many of these directors of companies that own self-managed super funds also own or are syndicates with horses? And if they're in sort of horse syndications, then there is this common goal, and that is we want the horse to win, right? But there's also this shared income approach to it, and that income comes in via the syndicate and then gets distributed out to each partner in syndication. And so I've seen often those horse investments as being considered a partnership from a tax point of view, and can be problematic. So you've got the director, they're not relatives, right? They're not members of each other's self-managed superannuation funds, and then they go and buy a horse together, and it clouds the whole situation for the fund. So does it mean the self-managed super fund or directors can invest via the self-managed super fund in the same investment if they're not members, or if they're members of different funds? Yes, they can, right? And if they're not trustees or directors of the corporate trustee, then yes, they can. So that's the other thing too, is that you don't want a self-managed super fund with directors or with business associates, and they go, right, well, let's keep it clean. I'll have my own self-managed super fund, you have your own self-managed super fund, and then you both become directors of the company, or you appoint the one company to act as a corporate trustee of both self-managed super funds. That's going to create problems as well. Basically, if you're not in a relationship with somebody, then my plain and simple view is you shouldn't be in a self-managed super fund with that person. Right now, that's not our position to say, but when we're reviewing funds, it's going to clearly create problems if people that aren't related are in the same self-managed superannuation fund. So in-house asset traps. One of the things that I want us to talk about here is so one of the questions that's come in, just let me read this. Hi, Tim. Earnings from a horse are considered a hobby and not taxable unless you're running a business. What are your thoughts on this? I haven't had too many thoughts on this, but I guess it depends on how that income is going to be considered and how you would structure the investment. So if I was thinking sort of off the cuff, I would think that you would have to declare that income in certain circumstances. Maybe there are other circumstances where you don't declare that income. And depending on if you are, the more horses you own, I suspect the more likelihood it is that the tax office want to see that income. And so if you're dabbling a few dollars into one horse, you're probably okay. If you're doing it at a higher level, then I suspect you've probably got a few issues to be mindful of there. So I really haven't given too much thought to that, but I certainly can give a little bit more contemplation to it in the future. But I want to really focus on this area here a little bit more. I think particularly the loan stuff and the financial assistance is where we get caught up the most with regards to self-managed super funds and these spaces. So I want to focus on the definition of a loan and clearly what that means for us moving forward, particularly in a COVID and post-COVID environment, because from an SMSF point of view, a lot of these areas fit under this sort of nasty definition of what a loan is. So our standard appreciation of a loan is where someone lends you money and you have an obligation to pay it back. Right? Interest isn't necessarily a requirement for there to be a loan. There needs to be that obligation to pay it back. But it also includes this provision of credit or form of credit or financial accommodation. And this is from the broader definition of the asset or the in-house asset rules under ruling 2009-4. But then really importantly is ruling 2008, SMSF ruling 2008/1 about the provision of financial accommodation to members and relatives. And I want to focus on that because under this definition of in-house asset, we've got financial accommodation and we've got this idea here that includes the lending of money, but importantly, it includes instalment payment arrangements and arrangements for the deferral of payments of entitlement. And if we look at that situation specifically, then that sums up the third part of COVID-19 for us. Installment payment arrangements and arrangements for the deferral of payments for debts or entitlements, that's rent relief. So rent relief is a loan. Rent relief is financial accommodation. What it means from the compliance point of view for the fund moving forward is of significance subject to the arrangement in place with each of the parties associated with the rental rent deferral. Because we're talking about in-house assets being investments in related parties, loans to related parties, loans to companies and trusts. Then we also have to incorporate individuals and where they sit in these sorts of issues. So when we're talking about an in-house asset that is a loan too, everything that has just happened in the last 18 months lends itself towards being a loan under the extended broader definition of a loan for SMSF investments. And I'm going to move through the COVID stuff as we go on a little bit further into the presentation. But my bigger warning about all of this is that a loan to a related company is fine. A loan to a related trust is fine. We then have this section 65 prohibition, right? And section 65 says that we are prohibited from lending money to a member or relative, and we're prohibited from providing financial assistance to a member or relative. And that this prohibition overrides the in-house asset rules. So right now we're in this legislative quandary because the tax office have addressed the in-house asset rules and what COVID means for it. But they've kind of gone a little bit more silent with regards to the financial assistance things to members and relatives. Now, what I'm saying there is that rent relief was available for everybody. right? And in a commercial sense, rent relief was available for everybody. If that rent relief was provided to a company or trust, then the deferral is considered a loan and therefore an in-house asset, and there's an in-house asset exemption that's been introduced. But if that deferral is provided to an individual or a relative who leases an asset from the self-managed superannuation fund, well, in this sense, it actually fits under financial accommodation and would, in the normal sense of the world, be prohibited. But in the early stages, all that's to be forgotten. So in the first year, rent deferrals, rent waivers, and that is almost irrespective of the parties associated with it. But in the future, if the individual defaults on making their increased rent payments or takes longer than usual to pay it, then we don't have an exemption covering their activities. And so once we move out of the 1920 and 2021 year, then we're going to have some audit concerns with regards to assets that are subject to a lease to a related party, where that related party is an individual. So business real property, we can lease that to an individual. And that individual can be related. There's no issue associated with that. They pay their rent in. If they don't pay their rent in, it doesn't impact the business real property. It impacts Section 65 and the financial accommodation. So how are we going to rectify that in time? Will the ATO take a common sense approach to those sorts of funds? We have to monitor it. We don't have any sort of legislative instrument pushing us in one way or the other. So partnerships, like individuals, are problematic because they're not considered to be an entity. They're the individual separately. So if we're leasing assets to a partnership, if we're providing rental agreements and rental referrals or deferrals to partnerships, are also going to be problematic. So when we're talking about this financial assistance stuff, we need to be mindful as to what it means moving forward beyond our early COVID issues. But in a broader sense, we need to understand what financial assistance is, because it's a breach in every given year and the biggest breach that we have. Right? So from a value point of view, in-house assets generally are the largest number of breaches. They represent about 30% of the value of breaches, but based on the number of breaches, financial assistance is the number one SMSF breach. Right? So funds financially assisting the members of the fund represent 1 in 5 contraventions. Now, I'll go through a couple of examples of what that means in a moment, but ultimately anything that carries a risk, financial risk to the superannuation fund, right, is financial accommodation. So I always put this point in here about carrying on a business, because people ask the question, can a self-managed super fund run a business? You won't find the answer in the law. You might find the answer in the deed. If you want to run a business, your deed has to provide you the capacity to do it. But running a business carries financial risk, and it's current day financial risk. And so if you're running a business to move that risk to the super fund away from yourself, then are you providing financial assistance to the members or relative? Short answer to that would be yes. Of course, undertaking business activities requires a far greater, more in-depth sort of review of the transaction to see what's actually happening there. If you've got non-arm's length transactions or non-arm's length events and they're more favourable to the related party, then that is going to be a risk. Now, we're going to talk about non-arm's length income and non-arm's length expenses once the ruling is finalised from the ATO. It's been sitting there waiting for about 18 months to be finalised now. We really need to see that. Primarily, we need to see that for the whole point about, can you offer cheap admin fees, things like that. But it has far broader consequences, and the whole non-arm's length expenditure is relevant across this whole financial accommodation point of view. If it's not usual or normal commercial agreements, not consistent with the fund's investment strategy. I did a webinar on investment strategies the other day, And one of the points that I highlighted with regards to the fund investment strategy was really simple. If you want something in your super fund, put it in your investment strategy. Right? It's as simple as that. We used to have an investment strategy that took a whole page to say nothing. Right? It was an investment strategy that said, we're going to make this amount of money, which was always wrong anyhow. We're going to make this amount of money and we're going to do it by considering all the things that the law tells us to consider. That's not an investment strategy. That's an investment requirement regurgitation. So it's not actually setting your objectives. It's not actually setting what you're trying to achieve. And I was one of the many people that said investment strategies aren't worth the piece of paper they're written on, because self-managed super fund members are responsible for their own investments in effect. And so there was no real point to having a strategy. Set your plan, go out and do it, succeed or fail, full stop. We've gone full circle a little bit from an industry point of view, and of course now the tax office are putting far greater emphasis on the investment strategy, and they did it because there was a couple of funds that went through audit issues, and the auditor didn't reference the investment strategy versus what the fund had invested in, and trustees complained, or tax office audited the fund and said that the fund wasn't acting in accordance with the fund's investment strategy. So we've got to take a lot more interest in it. If we want to lend money to related parties, if we want to engage in in-house assets, no issue to put it in the investment strategy. So therefore, when we're considering these issues, these financial accommodation issues, we're actually addressing them at this point in time. So, these are all the sorts of areas where we can address or create financial assistance. And to highlight what that means in a more specific way, gifts to members. Gifting members is it's number one on the list in the ATO ruling. It's probably the bottom of the list in the reality of self-managed super funds. I've very rarely, if ever, seen a self-managed super fund give a gift to the members of the self-managed superannuation fund. And I think even the examples that they provide are relatively useless in that sense. Whereas all these other areas, so selling assets for less than market value, okay, there's a situation here. Okay, if you pay me this, I'll give you the asset, right? So we're not dealing on an arm's length basis, so we're creating problems. Purchasing assets for more than you're allowed to, or more than what their market value is. So I'll pay out this amount from the fund to buy that asset from you. We have to deal at market value, so we need to address that correctly. Acquiring services. Now there's a whole area in and around services, and services are under the pump now. So the whole non-arm's length expenditure, trustee remuneration, contribution rules, they all come back to providing services to self-managed superannuation funds. What can you provide for free? What can't you provide for free? Who can provide it? It's a real sort of problem area. And so if you are providing services, and is it in the best financial interest of the members of the fund? So if you are providing services, then you need to make sure they're all done in accordance with so many areas of the legislation. If you can get an external to do it, then there's always going to be arm's length, right? Third party associated with that transaction. Forgiving a debt, releasing somebody from their financial obligation, and delaying recovery action for a debt owed. Again, they're bolded. Why are they bolded? Because they're my COVID measures, right? They're exactly rent relief under COVID. Right? Some people waived the debt, some people deferred it, right? Some people reduced it. So, what transaction has occurred, because all of those transactions are financial accommodation. All of those transactions are financial assistance, and in the normal run of business, none of them would be appropriate. And in a COVID sense, none of them are appropriate if they're not done commercially. So I've got a little bit coming up later about what you should be seeing, hopefully, for any fund that's done rent relief with regards to their business premises in the self-managed super fund. Taking on member obligations, giving guarantees over assets. So all of these things represent financial assistance more than just lending money. And the amount we can do in all these situations normally is zero. Right? So we can normally give no rent relief. We can normally forgive no part of the debt. Right? But COVID was unique, but the fact that we've had it as far as the funds and structurally goes, it means we now have a precedence in theory for how to deal with these sorts of situations in the future. Whether that means for us to get any relief from the government will require a global pandemic or not, because what's interesting is that a lot of our legislation now references, economic events on a global scale, but COVID-19 wasn't considered significant enough economic event to impact other parts of superannuation law, like the transfer balance cap and things, but it was obviously enough to impact a lot of these in-house asset rules that we need to be mindful of. So all of these areas become relevant. As I said, those 3 points to me also lead to COVID. I'll touch on the rent relief stuff as we finish up. One of the questions, so when Shelley was having a word to me, one of the questions that was asked internally about financial assistance was this link to separation of assets. And so I was doing a little bit of research in this area, and the question posed ultimately, or the question that I found an answer to in regards to this issue was the typical question. I actually had this question a week ago as well. So this was answered, let's say 20 years ago, right, by the tax office. I still have this question coming up occasionally, which is, we put the money in the wrong bank account, right? So the first question you've got to ask is, did you deliberately put the money in the wrong bank account, or was it an accident? Right? Now, there's only one correct answer to that question, but then you're testing trustees' skill set to see whether you get the correct answer. So it has to be an accident, right, for it to not be an issue. If it's not an accident, then it's financial assistance, right? So then it's straight away going to be a Section 65 issue. If it's an accident, then it is a Section 409 or Regulation 409A issue. Right now, when this interpretive decision came out, there was no Regulation 409A. So this was a slap on the wrist issue. Right? You put the money in the wrong account, don't do it again, albeit that when you read the interpretation, it says, but we expect you will do it again. But when you do it again, we'll say, don't do it again. Right? But there's no ramifications if you do it again, unless you don't act immediately, right? So in the first instance, I would say when people make incorrect, genuine errors of banking, because the broker's putting money here and there and everywhere, or somebody's is depositing the money into the wrong account, it happens all the time, right? Own up to it, rectify it as soon as it's recognised. Then you've got a separation of assets issue that has been addressed, right? If they don't take steps to fix it, Section 65 it, right? It can be one of those areas that would be addressed from a Section 65. I think now you've got the capacity to address it from a management level point of view and say, okay, well, if you haven't fixed this, you've initially got a separation of assets, putting money into your personal bank account. Initially got that. The fact that you're not fixing it or you're doing it quite regularly is there some form of other activity which is a little untoward? If so, then it's a Section 65. Now that's the order I'd be addressing it. If it's a inadvertent error, is a separation of assets issue first, and then a financial assistance if it's not rectified straight away. Any sort of issue or question with regards to that? So look, we've been going for about an hour. So if I suggest, if it's okay, if we have 5 minutes, just so everyone can get some fresh air, and we'll get into the nitty gritty of the rest of the in-house hazard stuff. So if we come back in 5 minutes, I will kickstart the second part of the presentation. Okay, so make sure I unpause the recording so that everybody gets to, that doesn't get to watch it, who, you know, wants to go back and watch this in their own spare time, which I'm assuming is all of you, because I always like to go back and watch myself present over and over again. That those people can get the presentation. So let's move into the second part, because the first part of it was really about addressing that key difference between financial assistance, which is really individual based from an investment point of view, versus the investment in the company and trust, which gives us the capacity to lend and do all those other things. So it's really the key difference between those two areas. What I want to be able to go on now and just expand on some of the definitions and what it means then from an ongoing point of view, from an investment point, but also then finish off with a little bit of a link to the COVID stuff, the valuations, and subject to time, I'll talk very briefly about acquiring assets from related parties. But I guess where we need to address the whole expanded definition is taking ourselves beyond the loan bit, because the loan bit is the more complex area, because you've got the split between those two areas as identified. And then you've got the next part, which is the investment in. So what it means to invest in something, and then the assets that we lease and have lease arrangements for. So when we're investing in an asset, it does mean to make a contract for the purpose of gaining interest, income, profit, or gain. And so again, when I start to touch on and talk about property investments at our next presentation, and we'll discuss joint ventures slightly more, then what we actually have to try and address is, what is the SMSF trustee investing in? Are they investing in the property, or are they investing in the company or the trust that holds the property? Because often to the trustee themselves, it's all irrelevant, right? For them, they see the end investment, right? So the limited recourse borrowing arrangement, for example, they see the property, right? Whereas we see the liability and all those sorts of things, and we have a net position, they just see the property. So in effect, you know, this is not really 100% accurate, but in effect, our SMSF investment is in the bare trust, right? So it's whether or not that whole transaction's working correctly, even though we report it as the property and all those sorts of things, we have to look at the structure around the end investments. And so when we're contemplating an investment in, right, then we're looking at the company or the trust that they're investing in and making sure that it satisfies the certain requirements. As I said, a lease or a lease arrangement basically is provision of exclusive property over a particular asset. So lease arrangements now and leases themselves outside of property transaction, the most common areas you tend to see, and I know that you'll all be able to give me hundreds of more examples, but outside of property transactions, you start to touch on farming equipment, any sort of, I guess, business machinery type situations. Taxi licenses, although they're becoming far rarer now in the worlds of Uber and share riding, cray pots, water licenses, all these sorts of things where there is a capacity to generate income from, is normally when an SMSF will invest in some sort of leasable type asset. And what we can do as far as who we can lease it to and the parties associated with it will often then be linked back to the in-house asset rules. Under the acquisition rules, we can acquire a loan from a related party. We can acquire an investment in a related company or trust from a related party. We cannot acquire an asset subject to a lease to a related party from a related party. We'll revisit that a little bit later, because that in itself is a complex sentence to say, let alone to understand. So one of those areas to be mindful of. So what it all looks like really in very simple terms is that basically you have the self-managed super funds, and any loan from the SMSF to a related company or trust is an in-house asset. Any investment from the SMSF over there is a in-house asset, or any lease of an asset to a related company or trust is an in-house asset, but it doesn't apply to members or relatives. So we have to distinguish between when we're dealing with members and relatives, and financial assistance versus companies and trusts, and then their in-house assets as such. And we've got a 5% fund limit, and we must comply continually. So in-house assets is one set of rules to test on acquisition, right? And then one set of continuing rules to test on an ongoing asset valuation basis. And they're the areas that we need to be able to satisfy, in that most of the time from a valuation point of view, what you're actually addressing with regards to acquisition of property or whatever else, you want to make sure that everything is done and you've got all the supporting material. But when you're reviewing the acquisition of an in-house asset, you're also measuring all the other assets of the fund at that same point in time. So normally any acquisition comes in of a stock standard of investment for self-managed super fund, you don't care what else the fund has at that point in time, right? As an auditor. If it's an in-house asset, you want to know that at that acquisition point, that acquisition is less than 5%, or that acquisition plus all other in-house assets at that time is less than 5%. And if it's over 5, then you've got a breach. That's an area that needs to be managed and effectively acted on by the SMSF trustee. And then we go through the whole process again at 30 June. Where's our valuation? Excuse me. So that we'll edit the recording later. Where does the valuation sit with reference to that 5% number? That's pretty much a summary of all of those issues. The key to the way that the rules operate is, if you go over that 5%, right, the trustee, so going over 5% in itself is not the breach, right? Not undertaking the writing of a written plan to get below 5% is the breach, right? So what we have to do is, when we go over 5% from an in-house asset point of view, the trustees must prepare a written plan. And it's a pretty straightforward plan, because the law actually tells you what the plan is. It says, what are you doing by means of disposal to get down below 5%? So right now, in a COVID environment, because of a regulatory instrument, we've got this situation where you must, even if you have gone over the 5% under COVID, you must put in place the plan. If there's no COVID, you've got to follow through on the plan. Right? In the current environment, from an audit point of view, particularly when you get to auditing 2021, but quite relevant in the 1920 year, is if somebody breached, and I've got this in a slide anyhow, but if somebody breached the in-house asset rule in 1819 year, and then they're still above that 5% at 1920, then there is actually going to be regulatory relief if they didn't implement their plan because of COVID. But as long as they wrote the plan and were prepared to follow the plan, but it got kiboshed because of COVID, then yes, we're going to need to monitor it next year where it's sitting. But COVID was that once in a global financial crisis opportunity where you don't have to follow the plan. But that's not what the law says. The law still requires you to prepare the plan. And then we just need to take the next step. I've just got a question coming through. So can I talk about what happens where there is an in-house asset, loan is over 5% during the year, but comes back under on purpose? Right, well, on purpose would mean that you've effectively lent more money than the initial valuation. So you're going to have two situations that arise with an in-house asset that's a loan. So before I earlier made the comment that in-house assets, if you're going to lend money or invest in a related company, then lending is more beneficial from an in-house asset rule, because in theory, the loan goes down as the rest of the assets go up. So you're moving away from that 5%, whether it's the investment goes up, the fund goes up, and it's a race to see whether or not the fund stays ahead of the in-house assets, right? If during the year, you're not going to be assessing the loan on every given day to see whether or not it's going to be over the 5% of the value of the fund. Ultimately, in most sets of audit circumstances, you're going to be reviewing that at the end of the year to see if it's under the amount. However, if they enter into another loan, right, so they deliberately take out more money to push that level over and above the in-house asset limit of 5%, then they've got to breach. That's effectively the same as acquiring a new investment. It's going to push it across it. So we need to be mindful of that. You've got other areas that you need to, I guess, report on or at least contemplate reporting on. And this is where it gets, to me, a little bit trickier, and people might have different views on this. But if you've got your loan in place, and in theory, you should be making your principal and interest payments, right, subject to the terms of the loan, and you want to keep it as commercial as possible. And so if there's no interest payments being paid, or no principal, then are you capitalising that? And that should all be written into the original loan agreement. So if you're starting to not pay the interest and not capitalise it and undertake all these transactions that are non-commercial in the sense of the operation of the loan, then that in itself can be problematic. And, you know, at the very least, it should be reported back to the trustees to say, look, you need to fix this situation and get moving back in the right direction. But again, from a significance point of view, if there's a pattern there, then there's nothing to suggest that you can't report it to the ATO for them to take further action with regards to it. So I'd just be mindful of people that are engaging in loans and adding more money to the amount that they're borrowing if they're in and around that 5% requirement. So yeah, so preparing the plan is important. As I said, I'll touch on the COVID rules a little bit later, but right now it's the preparation that's key, and then the plan's going to be, what are you doing once we move out of a COVID environment? You know, and if we get back to the point, the difficulty right now, you take Melbourne, right? So Melbourne, I know that, and I don't know about your offices, but I know our offices, our staff moved back in this week, right? So this is the first time they've been in the office in Melbourne since March last year, right? So were we paying rent, all those sorts of, I don't know what the situation is, but I'm assuming that a lot of people would have had rent deferrals or rent waivers up until now. And so that means their get out of deferral period is going to be longer, because the government have provided for this period of recovery to get out of it. So what is recovery is something that we're obviously needing to be mindful of with reference to the way that we operate moving forward in this space. So I think it's an area that we do need to watch this space on, and hopefully get a little bit more information, but the plan preparation is still key. So we talk about all these in-house asset rules, loans, investment in related companies, investments in related trusts, and we're restricted to 5%. That's a simple rule. But the reason that's the last question I asked, which is the valuation point, is because we have all of these exceptions to the rules. Right now, I'm not going to sit down or stand up here and go through life policies and widely held trusts, which in effect are managed funds. I'm going to touch on, in effect, two, but primarily one of the other exceptions to the in-house asset rules, because it's probably the most relevant one that we come across from an investment structure point of view, and that's our investments that are specified in the regulations not to be in-house assets. Okay, so to address the rules, there are other assets deemed by various legislative instruments and that not to be in-house assets, and one of those are our limited recourse borrowing arrangement holding trusts. Okay, so the holding trust is not an in-house asset, neither before we set up the loan or after the loan is disappeared. So that's the key issue about LRBAs, is that the asset in theory can remain in the holding trust forever. All right. So we can have the holding trust, we can have the property in it, we don't have to transfer it to the ownership of the SMSF upon paying it out. It's an exemption to the in-house asset rules. Okay. Obviously, for cleansing points of view, it's better to do that, particularly if you've got a corporate trustee over that holding trust where you're paying additional ASIC fees and all those sorts of things. you may want to transfer it out, but there's no requirement to do it. Similarly, this SPR, this recent legislative ruling, which basically says rent deferral, right? Rent deferral from a self-managed super fund, from any fund to a related entity because of COVID is not an in-house asset, right? So in the 1920, in the 2021 year, and then there's a clause, and for future years, these investments that are triggered in this 2-year window, these rent deferrals will never be registered or recorded as an in-house asset. Now, that's the pretty answer, but I suspect at some point in time there will be a not so pretty answer, and that is those trustees that, well, not trustees, but those tenants that neglect to start paying back or take some sort of action against the original rental deferral agreements, then at some point in time, that's going to have to be triggered as either financial accommodation or something else and be raised as an in-house asset. But the deferred rent, right, not the waiver, because the waiver is a separate issue. The waiver's gone. Once you've waived it, you've basically waived it goodbye. Right? The deferred rent is not an in-house asset now or ever, because the objective is to pay it down. So you'll see that rent deferral, you'll see it's not an arm's length transaction. As long as it was done on an arm's length basis, then there's no problems moving forward. But these 1322C trusts and companies are the biggest exemption to the in-house asset rules. The tenants in common one and the business real property, obviously business real property is probably the most significant, but it's also the one that people appreciate and understand the most, is that you've got business property and it's leased to a related party. It's not an in-house asset. It's like the golden egg of SMSF investments. The 1322C trusts and companies are a little bit more problematic because they have all these boundaries and these rules set around them, where if we get it wrong, it's actually far worse than getting the in-house asset rules wrong. Right? If you get the in-house asset rules wrong, write a plan, get down below 5%. You get the 1322C rules wrong, the plan is get rid of the 1322C trust. So it's a far greater cost to get things wrong under the 1322 environment than it is under the in-house asset. So the way that these, and I've referenced them as non-geared investments, and so they're under regulation 1322B and 1322C, and the B and the C is a date specific, right? 28th of June in the year 2000. Now, my 30-second history lesson is that this was introduced because in 98, 99, they said the self-managed super fund can invest 100% in business real property, right? So we can invest 100% in business real property and you can lease it to a related party. But we also had a rule that said you can invest in a related trust or a related company, but you're restricted to 5%. So then the question was posed, well, what if we only invest in business real property in that company or trust? Are we still restricted to the same 5%, whereas we can own 100% of it directly in the super fund? Government said, great question. Probably they didn't say that, but they said, okay, we don't want to have a differential between the way you can do it. So we will introduce these rules around its structure. And if you hold business real property inside a company or a trust and it meets other rules, then you get the same exemption as you do for business real property normally. All right. That might have been just slightly longer than 30 seconds, but ultimately that's where these things came about. And by extension, under any law, there's always additional circumstances that you can get out of having these sorts of investments. So for the rules to apply, for it to be exempt from the in-house asset rules and not be considered a related trust, that trust or that company cannot borrow, right? Hence, non-geared investments, right? So no borrowing, does not invest in or loan monies to individuals or other entities, right? So the trust, the company cannot loan money out to anyone else, just like the super fund can't lend to other individuals. The restriction here is we cannot invest in other entities. So this trust cannot invest in shares. This trust cannot invest in other trusts. It doesn't say that it can't invest in residential property. It doesn't say that it can't invest in collectible and personal use items, you might not want to be using it for that purpose, but it just restricts you from investing in other entities and other companies, other companies and other trusts. Has not acquired assets from a related party of the fund other than business real property. So the same business real property rules apply that apply in normal set of circumstances. Does not carry on a business or doesn't lease assets other than business real property to a related party, does not carry on a business. That's a real tricky one, because property development is an area that, as I've talked about, a lot of people are keen to do in a self-managed super fund. So a lot of people say, well, we're going to do it through a trust. Point becomes, when does property development move from being a project to a business? And that's really what you need to identify is, are we undertaking a single property development, which is actually just the building of a property to then lease out from a long-term point of view for generating revenue for the fund? Or are we buying property, selling property, buying property, selling property, and then we're heading more into the trading trust and carrying on a business environment, and we're in breach of 1322C. So we need to be mindful of that and conduct all other transactions on an arm's length basis. So again, when we talk about non-arm's length income, when the ruling is finalised about that, touch on this area, because if a self-managed super fund doesn't deal on a non-arm's length basis, then the investment from that income is taxed at 45%. Tough luck, 45% deal with it, but no issue with the fund. If that same investment is held during a 1322C trust or company, then not only is the income of the fund taxed at 45%, you're in breach of these regulations and you have to wind up the trust. So there's a huge anomaly between holding directly and holding indirectly, and then you get a double whammy of tax and compliance to be mindful of. So areas to certainly be careful. So we can hold non-business real property as long as we didn't acquire it from a related party. So again, I will touch on this more inclusively in our property presentation, but these are awesome vehicles to hold property in because of the power to acquire shares or acquire units from related parties and all those other opportunities. But it's, on the flip side, problematic if you do things incorrectly, because then you've got compliance issues that double up. You can hold business real property, even if it is acquired from a related party, cannot hold shares or anything else. So bank, property, or bank, other non-entity based investments. Assets can't be used as security. And if you lose the exemption, you lose it forever. So there is another clause within it under 1322. So we'll go through the events in a moment that create problems. But if you lose it, it's lost forever, except for this year and last year. Right. So for this year and last year, these entities have been captured under the whole in-house asset inclusion to say, if the income is reduced, so therefore we are dealing on a non-arm's length basis in normal sense of the world, then if it's done that because of COVID, then you're not creating a problem for your fund. 1322D, that's what we want to avoid. All right, if we enter into a loan agreement or invest in another entity. So in the normal sense of the world, if we enter into a loan, which is that we provide that rent deferral, that's a loan for the terms of super point of view. So if we do that normally, we've created a problem for the entity. Right? In this case, right now, we don't have a problem. If we borrow or give charge over an assets, over the asset of the fund, that's a problem. If we conduct business, if we lease an asset, so residential property for a related party, we create a problem. If we conduct our transactions on a non-arm's length basis. So one of the issues that you've got to be mindful of is that the income's got to flow down through the trust into a superannuation fund. And why we want to try and keep these things separate is if we've got other trusts and they shoot income into the fixed trust, and then that trust distributes income to the self-managed super fund, and we've got non-arm's length income issues. Touch on that a lot more when we deal with non-arm's length income at a future date. And the other key one is if your fund membership goes above 4. Now that law will change, that sentence changes if the number of people we can have in a self-managed super fund changes. Right? And so if we increase above 6, if we get that changeover. Right now is if you have more than 4 members in your super fund, you've got a lot bigger problems than just your 1322C trust anyhow. But ultimately that's going to tarnish the fund transaction. When you do all of those events, if you do any of those events, you create an ongoing problem for the superannuation fund. So 1322C and 1322B, trust or company. Most people like myself will use the word trust all the time, but they do apply equally to companies. People often say, well, what's the difference between investing in a 1322C trust versus a 1322C company? And to me, the biggest issue really is that companies obviously can retain profits and do other things, whereas a trust must pay the distributions out. That to me is not a big enough reason to go one way or the other. In the SMSF space, most people will go down the trust path and pay the distribution. One of the comments that I didn't make earlier in regards to loans and what would be considered a loan or not is the timing of the payment. Right. So one of the biggest issues that we've always seen with regards to these trust investments and self-managed super funds is that at 30 June we report the trust distribution, and then the trust distributions needs to be paid into the self-managed superannuation fund, and that will often not happen until very late in the next financial year after the trust financials are finished. Well, again, these sorts of areas around what is not considered a loan includes late payments of income that is being expected. So if there is no arrangement in place and the trust inadvertently overlooks a payment that's normally happens in July or June and it happens in July, that's probably a tap on the shoulder and say, look, let's just be mindful that you've got this distribution reported 12 months previously. You need to pay it as soon as practicable. Yes, there was an oversight, don't do it again type scenario. If that isn't paid for 2 years, 3 years, whatever, then we start to delve into the area of financial accommodation. We delve into the area of, is there actually a distribution being paid, or have we got a new investment in that trust? And again, the new investment in the trust, if it's 1322C, that's not necessarily an issue, right? Because we can have investments in these 1322C arrangements, but we want to be addressing them relatively early. That's very different to other styles of trusts that self-managed super funds can invest in. And primarily the key one here is anything that was around before 1999. Now, a lot of you would be going, well, how many self-managed super funds have investments that are over 20 years old? Plenty would be the answer to that, because most self-managed super funds that are around in 1999 did it so they could invest in these sorts of trusts, because these in-house asset rules that I've been talking to you about only came in August 1999. Before then, a self-managed super fund wasn't called a self-managed super fund, called an excluded fund, and it could do pretty much whatever it wanted to do. Now, there was reasonable things they couldn't do. You couldn't invest in certain employer stuff, but all these related trusts, residential property, all that sort of stuff, it could be done. So you could own a residential property and the members could live in that property. That could all happen before 1999. Saw some really interesting investments back in those days. But what they basically said was any investment that you held as at the 11th of August 1999 wouldn't be subject to the new rules. So any unit trust, and most of these investments were through these unit trusts, any trust that you held at that time would be subject to the old rules and not subject to the new in-house asset rules. So when you hear people talk about pre-1999 unit trust, what it basically means is that they're investing in a trust that can borrow money, right? That can carry on a business, that can lease residential property to a related party, as long as the lease has been unbroken. So as long as you've lived in that place for the last 20 years and you haven't changed the circumstances. You don't have to repay the borrowing, albeit that I'm sure the lender would like you to repay the borrowing. It was not an obligation that it had to be paid back by a certain date. A pre-99 trust can enter into new borrowing arrangements. What these trusts are subject to is the standard investment rules, sole purpose test. So why is your self-managed super fund still investing in it? If it's doing it to satisfy the sole purpose test requirements, which is to provide retirement benefits for the members, then no issue. So we're still looking at these things from a commerciality point of view and from an arm's length transaction point of view, but you don't have the borrowing restrictions and that you do have with the 22C styles of investments. So they are still a very meaningful investment if people have got them. The thing with them is you cannot invest in them anymore since 2009, since 30th of June 2009. Or let me preface that by saying you can't invest in them anymore since 2009 without them being tested as in-house assets, right? So any reinvestments of distributions, which was stock standard in these investments that you made up to 30 June 2009, was also exempt from the in-house asset test. If you had borrowings, then you could invest up to the level of borrowings that you held back in 99, that would not be an in-house asset. But now, if you want to reinvest the distributions, then those units will be counted as in-house assets and subject to the normal investment in related trusts. So almost these pre-1999 investments are something that are kept totally segregated from all new investments in the fund, and we don't try to reinvest anything else in them. But as far as what they can do, it's a little bit of, and you shouldn't use terms like anything goes, but ultimately still is anything goes comparative to all other investment options inside the SMSF space. Yeah, and so that's the loan agreement part there. Back in 99, if you had a level of debt, so let's say you had $500,000 debt outstanding in 99, you could declare that you weren't going to reinvest the distributions, but you could reinvest up to that loan amount, which was, again, a provision that applied up until that 30 June date. So all those investments were never in-house assets. All those investments since then will be in-house assets. So the question, though, that does get asked occasionally, because we do see these, most of the funds that you're going to have are coming from your accounting clients. Most of your administrative clients, administration clients, because they're dealing with financial advisors and stockbrokers more so, right? They're not going to have so many pre-99, but your old school accountant, right, who maybe hasn't always kept up with all the rules as well, they're going to have all your pre-99 investments in it, because most clients aren't going to leave that accountant, right, because they set it up 20 odd years ago. They know everything about it, except maybe the rules around how they operate, but that's where you generally find where all of those clients exist in the SMSF space. But the question often does come about, like, I've got this unit trust and it doesn't have that debt anymore, right? Can I invest in that trust now? So we've got the unit trust, it's got property in there. We want to put some more money in, you know, potentially to buy more property or whatever. Can we invest in that trust? Short answer to that is, if there was no borrowings entered into after the date when all these rules changed back in June 2000, and the borrowings are repaid before the new investment is made, then you can convert that trust from a pre-99 trust to a division 13.3A, which is the 13.22C trust. I would argue that you're cutting off your nose to spite your face, because the restrictions around 13.22C are far more significant than the restrictions around pre-99. And so by undertaking that transaction, you're really limiting what that trust can do. So your ability to carry on businesses, the ability for that trust to borrow, all those sorts of things disappear once you go down the strict nature of 13.22C. But you do get asked a question, can the self-managed super fund invest further into this trust and it not be an in-house asset? We can only do it if you meet the strict guidelines of 13.22C. And the other part, and I touched on this a little bit before, is the unpaid present entitlements. And so this has been addressed in its own ruling. It was that big an issue that it got its own SMSF ruling, but it's also addressed in the financial assistance and the sole purpose test ruling and other things as well, marginally. and that is that if you've got unpaid present entitlements in the trust, and you go beyond, as I talked about before, your standard sort of operating time for repaying it, then it's in effect, if it's not a reinvestment, right, and that might be the way of sorting it out quickly. If it's not going to be a reinvestment, then it's going to be considered to be a loan to that related party. So the entity, the trust, if it's not paying its entitlements to you, then effectively you have provided financial accommodation, and that is deemed to be an in-house asset. So, you know, ultimately, yes, there's a capacity to, you know, under normal operating circumstances to have delayed payments. But if you've got this ongoing arrangement where these UPEs aren't being paid, then we've got in-house asset issues that we need to be mindful of. So it's one of those areas that I think we need to address. Hopefully that's being addressed or it gets sorted, but I suspect like with a lot of things, it doesn't always get addressed at that time. So to touch on the rent relief stuff, so I wanted to tidy up this whole this whole in-house asset thing with just bringing a little bit of current day environment around it and what it actually means. So very quickly, without getting too much bogged down into the details, rent relief is a real thing. Obviously, we've all heard about it. We know that it could be provided, and it could be provided on a case-by-case basis. It should be regularly reviewed, right? So all these are key issues that should be addressed in any documentation that's supporting any fund that has rent relief. It really, self-managed super funds should, where possible, follow the Cabinet's mandatory code of conduct as to how to apply that relief. And that was with how much it should be a waiver, how much should be deferral, and all those sorts of guidelines that were put in place there. But there's going to be a long-term impact, and that's going to be based on how much relief is provided. And I'm not going to touch today on limited recourse borrowing arrangements, but limited recourse borrowing arrangements also have their own relief issues associated with it. They are going to create, I think, far more problems than this rent deferral, because there's no extension of the term under a lot of these LRBAs, and so you're having to get the money paid back over a shorter time frame, whereas rental relief effectively was giving you longer time frame to pay the rent. So I see issues coming up more so from LRBAs than from rent relief. Just a question, sorry, I should have had a look before I jumped into this slide. What if the 1322C trust has overpaid its distribution? Okay, so talking about the distributions before. What if it's overpaid it? Look, I think the question's got to be how much it's overpaid it by, and whether there's a general willingness to accept it as a prepayment of the current year's distribution. You know, we tend to focus more on unpaid amounts rather than prepaid amounts. Now, the commerciality behind whether or not people will prepay trust distributions, are clearly in a managed fund sense, you'll get distributions paid on a quarterly basis anyhow, and then the final payment made in the next year. So I personally don't necessarily have an issue with an overpayment of a trust distribution if that overpayment can be offset against the current year's entitlement. But if it's a significant amount and it's more than say the next year's entitlement, then you're starting to deal with, okay, well, is that actually a distribution, or is it effectively a discretionary distribution? And when it's then it becomes non-arm's length income and a problem for the 1322C arrangement. But I would think you would base it often, or I would base it more so on the value of it as to whether or not it's a key issue. I will say too, in light of all the 1322C stuff, being mindful of time and wanting to get through these last couple of slides, the SMSF Association has just put a submission into government, which doesn't mean anything. I mean, you can submission your life away to the government, and it doesn't mean anything if they're not interested, right? And there's always a good chance that they're not interested. But they are looking at having all these 1322C provisions addressed so that there is more sort of equality between investing directly and investing via these trusts. So a lot of these issues around the trust distributions and things like that, whereas you'd have to put a plan in place to rectify it under a normal set of circumstances. In 1322C, you would have to unwind the whole thing, and there's inequality in that transaction. So what the SMSF Association have put in their submission is to say, COVID, if anything, has said you're treating 1322C as the same as a direct investment. Why can't we take that approach beyond COVID and treat these things like the same sorts of investments moving forward, which I think is a reasonably good common sense approach. Governments don't always take a common sense approach to the way the legislation is written, or Treasury, should I say, in that regard. So those share a common interest to resume normal activities, and this is part of this whole commerciality, right? So without going through all the points of the code of conduct, it's about trying to get back to normality. And so it's about parties working together to achieve an outcome. Now, you will see funds, and I've seen funds where the tenants and the SMSF trustees either don't come to an agreement or don't formalise that agreement, right? Or there's just sort of silence about what's going on. They're going to have problems, and they're not entitled to rent relief in that situation. And so you're going to have funds where there are breaches that are occurring in the 1920 and the 2021 year, but they're funds that are not being advised by anybody. Because if somebody's advising a fund on what to do, then it's so much easier to document this process and let it try to sail through the audit and ATO regime rather than to take the risk of not paying adequate rents and things like that and creating problems. So any arrangement's got to be proportionate and appropriate to the fund, which is that whole concept of, if you've had a 20% decrease in your turnover, then your rentals go down by 20%. Simple as that. That's what we're really looking at there. You had all those rules around the landlords and not terminating things, and most of those legislations now have cut out, right, or are cutting out in March with reference to rent reliefs and other things across the country, because federal put in this code and then the states had to actually implement legislation around various reliefs and things. So it's all sort of based on where your fund is based as to what sort of relief you're going to actually see. But the key things, I think, from an audit point of view, certainly from an administrative point of view, is you want to see a request from the tenant for relief, right? So you want to see 4 points, even if they're all in one set of documents, but you want a request from the tenant for the relief outlining why they need relief. I've had people on the phone saying, we don't want to provide our financials. But, well, then you don't deserve relief. Now, you don't say it like that. You can, depends on how you know the person or whatever, but say, well, if you're not willing to provide the reason why you want relief, then you shouldn't get relief. If you can't prove the turnover decline, then you don't have this entitlement, right? So you want that request. You want the decision of the trustee. So please, can I have rent relief? Yes, you can, or no, you can't, or whatever the answer might be. Acknowledgement of the relief inclusive of the term. So we're going to provide this, and we're going to include like a review period. We're going to review it after 6 months, and then we're going to say this is the period you've got to make good on those payments. So you want to see as much as possible, and that's not coming just from the code of conduct, that's coming from the ATO. And so that's the broader audit view of these things, is more documentation, the better to solve it. But if you provide all of that, then all of these related party and in-house asset issues go away from an audit reporting point of view, or rent deferrals. Waivers are different, right? But for rent deferrals and rent reduction, in that regard, that's where you see the benefit for the funds. So, as I said, the impact is the same whether it's held directly or via a 1322C style trust. So that document, the SPR 2020/2, provides relief for both styles of investments. So as long as the rent reduction is commercial, right, then it is arm's length, it is based on the turnover, and it's not an in-house asset issue that you need to be reporting from an audit point of view. There are issues to me, or in my mind, in how far this relief goes, right? Now, the common sense approach, questionable whether that applies, but the common sense approach is that this applies across all style of of investments and the way you hold it, but it doesn't necessarily identify that it's for pre-99 unit trust. But do you assume it because of the 1322C style trust and the directly trust? You know, so how far do we go? If people aren't cooperative, then there's going to be a problem. If we've got individuals and we're dealing with financial assistance, then where do we sit, given that Section 65 is not a part of this this tax office relief or this treasury relief? It's only the in-house asset rules. So, you know, will we have Section 65 issues moving forward? I think we have to watch this space a little bit with regards to that. So all we can do from a review point of view is ignore those issues for the current year and then readdress them in future years from an audit point of view. So what you're looking at is, did you have an in-house asset issue last year, as in 18-19? And what was their plan? Did they satisfy their plan at 30 June 2020? If COVID impacted them, they may not have. Well, that means they won't necessarily be in breach of the in-house asset rules because there was this exemption brought across for events that occurred from 18-19 into the 19-20 year. Okay, but I suspect that you'll be monitoring that from a moving forward point of view to see whether the plan has been fixed by the following year or not. And same with anything that happens in this last year, you know, put the plan in place, but you don't have to follow the plan through. So the key is there must be a plan. So you're still identifying in-house asset issues, other in-house asset issues, but you're not necessarily seeing them being rectified. And I think that's one area for us to be mindful of. So acquisition of asset rules are just really quickly. The only reason I want to address this here, and I've got some points there for you, is that we do have exceptions to the prohibition on acquiring assets from related party. And really the key ones is that you've got the in-house asset with the exclusions and the certain assets that are not in-house assets. So we've got listed securities, business real property. That's a subject for another day. What we also have is the capacity to acquire shares in private companies and loans to related parties. You've got the ability to acquire from a related party, but it comes back to those same few questions that I asked at the beginning, right? So when we're looking at acquiring assets from a related party, it's like, well, what are we acquiring? It's a listed security, well, we've got an exemption for that. It's a private company. Okay, who are we acquiring it, or is it a related company? If it's not a related company, we can't acquire it. If it is a related company, we can acquire it if it's less than 5%. So we've got to address all those same issues at acquisition point as we do for whether or not the fund can do it, whether it's acquiring related or not. So we need to address that sort of stuff. If it's an exemption, so it's business real property, if it's an exemption because it's a 1322C trust, then there is no limit on what we can do from an acquisition point of view there. So there's certainly some of the benefits. Last issue that I want to touch on is valuations. The valuations are probably, I guess, historically the bane of SMSF Audits' existence as far as how assets are valued. And there is no one size fits all approach to valuations. So what I'm really going to address here real quickly is what we provide to our clients about how they need to approach these sorts of issues. And these are ultimately based on the ATO guidelines. 1322C is pretty simple. Apply your standard property valuation guidelines to that. And that is that ultimately you should be placing a value on the property each year, right? And if that property valuation has been obtained in the last 3 years and the circumstances around the property haven't changed, then the trustees can adopt that existing valuation. You can then go a step further and say, okay, well, there's been circumstances, global event or whatever else that have impacted the price of property. So we should go about revaluing it inside that 3-year period. Everyone said COVID would affect property valuations. It seems to affect it the other way. Right? Instead of going down, well, property valuations have gone up. So, you know, that could provide reason for people to obtain, new valuations. Qualified valuations are only required for collectible and personal use assets. Right? Qualified valuations or independent valuations are pretty appropriate if you're acquiring things from a related party, but they're only mandated legally for collectible and personal use assets. But certainly we would recommend, to make audit life easier, that if someone is buying a property from themselves, that they don't value it themselves, but rather they get that separate valuation and undertake it accordingly. From a company's point of view, companies can be a little bit more difficult to value. So we would be asking for a share price of any share issues or sales within the last 12 months. Often you'll get, oh no, we haven't got anything like that. Correspondence from the company's financial offer with share price and an explanation as to how they arrived at that share price. Again, it can be often very difficult to obtain these things, but these are the sorts of questions that we do try and ask. Valuation of company assets and liabilities with evidence and calculations to support it. So it's not just a line from a carefully selected line that you prefer out of the set of financial statements that you've found. You know, there wants to be some sort of benefit associated with it. And the cost price of shares for the first year acquired. So obviously in the first year, you wouldn't need to necessarily go about revaluing it. And then from an ongoing basis, something from the signed financial statements would be ideal. A dividend statement, current market value, it's just anything that you can provide. Right? The more information, the better. And I suspect most of these issues become audit issues anyhow. I think most of the valuation things become audit issues where there's no justifiable reason for the price, or you've got the first year price and you're in the fourth year of the company and nothing else has changed significantly. One thing I'll say about that is that share prices can go up with private companies in that as well. And so often you'll see one offer where the value is quite low in the early stage of a startup or something, and then all of a sudden, I don't know, like Game Book or whatever that stock is, Game stock in the US, all of a sudden it's gone from worthless to billions overnight because, you know, and Elon Musk has just put $2.1 billion into it or something like that. And so the price does fluctuate. And if you happen to be the little person that puts some money into it early as a bit of a startup from an SMSF point of view, then that valuation can increase fairly significantly. Now, if it's a private company that's related to you, that can be problematic because then you might have to sell those shares. So you really want to go through some form of due diligence to get that valuation, and not too dissimilar from a trust point of view. So from a trust point of view, you want to obviously be able to see the financials. If it's a related trust, you really want to get an independent or valuation done of the property on the same sort of terms as you would for anything else. So just to finish off, from an anomalies point of view, not sure if I've got anomalies right. It's always one of those words that I've always struggled with. But anyway, that's just my own personal issues rather than super fund issues. Some of the key issues with these related investments: different treatment of business versus residential property. Okay, so we have to understand that there is a key difference between the two, from a tenancy point of view, from an acquisition point of view, not from a disposal point of view. And we can sell residential property to a related party, no issue there. The different treatment between dealing with entities and individuals. An investment in a related company is fine, an investment in a related trust is fine, an investment in a related individual is financial assistance. Leasing an asset to a company is all right, leasing that same asset to an individual is financial assistance. And that's one of the hardest things for trustees to get their head around. And the different rectification solutions between direct and indirect. And I've touched on that before. The breach of the in-house asset rules from an arm's length basis point of view, or for business real property, is you might have to pay high tax on a certain amount of income, right? Or you might have to sell a few units or pay off a bit of the loan. If you do the same thing in 1322C structure, you have to wind up that structure. So there is quite an anomaly there. So there's a lot of key issues to be mindful of. I'll wind and tidy up a lot of this piece when we do the next presentation on property, and so we can address a few of the more property specific issues associated with this in I think April at some point in time. I'm coming back to present on that. As I said, I'll give everyone a copy of the presentation. If anybody's got any questions, I'll look at the little Q&A on the thing, and it's not flashing at me at the moment. But also, by all means, you can always send me questions through. I'm in communication with you guys collectively all the time, like with Richard particularly, on a lot of these sorts of issues. So we're trying to reach a lot of common ground between ourselves, SuperGuardian as an administrator, and yourselves as auditors as well, on a lot of these matters. There are a number of acquisition of assets from related party issues going on at the moment between both firms, and Richard and I are trying to address those and include the tax office in that, so we can get a uniform position on a lot of these sorts of things. So, you know, we're very keen on working closely with yourselves, and so all the audit queries that you raise are beneficial for me to hear, unless they're like the boring ones that I don't really care about. But you know, all of these investment style questions are perfect. So thanks very much, and I'll see you all in April. And thank you, Shelley, for inviting me along today.